An emergency fund could mean the difference between a long-term setback and a short-term annoyance on the path to financial independence. But that doesn't mean it shouldn't still be fully employed and making you more money. I'm going to tell you a story that recently happened to me that really illustrates why an emergency fund is so important. And then I'm going to give you a couple options on where to keep that emergency fund so that it's still working for you. At the end, I'm going to tell you about an advanced tactic to keep your money employed that we may all be using here really shortly. Hi, my name's Will, and this channel is all about the path to financial independence. Me sharing it with you, you guys sharing it with me, and exchanging ideas along the way. So if you want to be a part of it, be sure you subscribe down below and leave me a comment with where you are on your path to financial independence and what financial independence really means to you. With that, let's get right into the video. So here recently, my emergency fund got put to use. It's been a little while since I've had to use it, but I'm going to tell you, it really saved my bacon. So here in Oklahoma, where I live, we get some frequent heat waves, at least a couple times a year, some severe heat waves. It just so happened that this year, though, right before one's going to hit, it's on the news. We've got about 5 to 7 days before it's coming our way. My AC goes out. Call the home warranty. I'd recently just switched after a very obnoxious and expensive experience with another company. So I have this new company. I call them up. And it takes about 4 days to get someone out, first of all. They get out there and we discover that the entire compressor unit and therefore the coil inside the furnace has to be replaced. No big deal though, right? Well, actually, in their fine print, down in that deep underbelly of fine print that I somehow missed, basically says that they're not going to cover replacements in the first 60 days of a new account, regardless if it's paid up or not. So, long story short, I have a 2-year-old. I'm not going to sit here and fight for a month without AC in 100+ degree weather. 2-year-olds and heat don't mix. So I have to take care of it. I have to cover it. Bam. Month and a half out of my emergency fund like that. Gone. But wait, it gets better. So some of you may know that I also switched departments and jobs here recently. I'm a government employee. If you've ever worked with the government, you know that every time you switch, you make a move, whatever, you may be going without pay. There's accounting errors or whatever. Well, of course, that happens right on the back end of the AC fix. So it's been a month now, and by the time this video comes out and I get paid again, it'll be about a month and a half that I've gone without pay. So here we are. The emergency fund's already knocked out by a good chunk. Then I'm going a month and a half without pay. Usually here's where I would be like, all right, talking to my wife, we're going to have to lean on your income. But wait. She, with my support, quit her job to focus on school full-time, starting this summer, just as all this happens. So just to recap here, we're on a single income. My AC goes out, and that's a month and a half worth of pay, which is almost half of my emergency fund. And I go a month and a half without pay. Needless to say, the emergency fund has been annihilated. But it's all that's been annihilated, and that's the point. The emergency fund's been annihilated, but I have no extra debt. All the bills have been paid, and everything that needed to get fixed has been fixed. Without the emergency fund, things could have gone far differently. And so this is why they really are so important. But there's been some conversation, how they should be employed, so I want to talk about that. So what is an emergency fund really? Kevin from Meet Kevin published a post here just last week, at the time of recording this video, that he talked about his emergency fund, and it was a little bit controversial. To be completely clear here, he was pretty extreme on his approach to emergency funds. But I think he has the ability to be, and I'm going to explain why. He made a really, really good point about the closer you are to financial independence, the less you're going to rely on that emergency fund, the less important it becomes because you have other avenues of support. So he's probably a little bit further along on the path than I am. I'm at the very beginning, I think. And so I think many of you probably are too. We're going to naturally be a little bit more conservative with our funds. Another key point is how conservative or risky you can be with your fund is going to also depend on your situation. So my family situation does not allow me to be risky. I have a young child that depends on me. Kevin might not. So with all that being said though, he also made a really important point about your emergency fund, that all your money, regardless of its purpose, should be optimally employed at any given time. All your dollars should be trying to make you more dollars. So there's kind of a fine line there though, and to really get your head around it, I want to dive into really what the purpose of an emergency fund is. I think the waters get a little muddy around this subject, and so I want to go right to the real purpose. So when you really think about it, there's two purposes to an emergency fund. One, to provide quick cash in a tight spot or to solve an issue, an acute issue that just comes up, like the AC. Two, to provide, coverage on your expenses whenever you have a drop or loss of income, like whenever you change departments and an accounting error loses you income. But really, both of those can be simplified even further to preventing debt. That's really what it's all about. So that in a tight spot or a weird situation like what I'm in, you can prevent further debt. And so if you think about it like that, it really puts it in perspective that is really what an emergency fund is doing, is covering you from incurring more debt. You see, the thing is that spending money is actually cheaper than spending money that's financed. It's just how it is. So if you are able to quickly have cash and cover an issue, it's going to be a cheaper issue than if you have to go finance it with a credit card or some sort of loan. So Kevin made another point that is probably the most controversial in the video, but something that I wholeheartedly agree with, and to me it just makes sense. If you have debt, you should pay the debt before the emergency funds. So if you know that your emergency fund is really meant to prevent debt, why in the world would anybody recommend for you to save up an emergency fund to maybe prevent further debt when you already have other debt? It doesn't make any sense. Why anybody recommends this is beyond me, but somehow that has become the traditional wisdom. To clarify here though, I'm talking about high interest debt. I'm not talking about your mortgage that's at 3% right now. I'm talking about anything over 4%. That's the line for me. If it's different for you, it'll probably be in the 4 or 5% area, but if it's different for you, that's fine. Basically, 4% is what I've chosen because that's where the inflation rates make sense, and I know I'm going to be making a higher return somewhere else with my money. So, pick your threshold. That is the threshold that you decide you are not comfortable with holding debt that is over that APR, and be sure that you pay that off before you worry about your emergency savings. Because if you have something go wrong, you're probably going to still be able to cover that, but you may not. Why in the world would you let the tail wag the dog and let some theoretical issue keep you from paying off debt that you already hold? It doesn't make sense. So what about the amount of your emergency fund? I'm going to have to tend to agree with traditional wisdom here and say initially you should shoot for 3 to 6 months worth of expenses. The only thing that saved me this time was I had a little over 4 months worth of expenses set aside. So how I approached this was, as soon as I was done paying my high interest debt off and I was comfortable with that, I got rid of that debt. The first thing I did before I invested in anything else was put 3 months into an emergency fund. And then after that, I just paid a monthly deposit. I have it in my budget, and every month it goes out automatically. So we've talked about the purpose, and you know now what the purpose of the emergency fund is, the end result, and you can keep that in the back of your head when you're trying to decide where you should park that fund. And you do want to keep it employed. So there's 2 criteria that you want to think about. First is the liquidity of it. You want that fund as liquefiable as quickly as possible or as quickly as you need it. For me, that's 30 days, a full 30 days. As long as I can get my money within 30 days, I know that I can turn around and take care of whatever it is I'm trying to take care of. But that's because I have other sources of funds in the short term, and I'm going to talk about that here in just a minute. But number 2, you want to make sure that it's still optimally employed. So for me, this means that it has to at least be beating inflation. If I have a fund sitting there and it's not at least keeping up or beating inflation, I'm really losing money. It's going to shrink rather than grow over the long term. I'm not okay with that. With that being said though, you don't want to overemploy it either. If you have an emergency fund that you're calling your emergency fund, but you lose it in the first week of a recession, it was never an emergency fund in the first place, and it's not going to do you any good. So now let's talk about the best options to park your fund. First is the high interest savings account. Yes, they might be going away here soon with the interest rate changes and everything, but right now I'm still making 2.5% at VO Bank. And while that might be going away, right now it's still there and it's still viable. And if you have an account that is working for you, it's still the best option in my opinion. You're completely safe as long as it's FDIC insured and you're at least keeping up with inflation rates at 2%. Number 2 is a no penalty CD. My favorite is through Marcus, Goldman & Sachs, and I'm not sponsored by them or anything. I just really do like that bank. Their high interest savings bank did get cut, and that's why I went to VO. But they have an awesome no penalty CD that's still earning 2.25% right now. Basically, you put the money in just like you would a normal CD, and you can pull it out without any penalty. Usually you would lose your interest and have a penalty. Some banks will let you draw it out without a penalty, but then you lose any interest you accrued. Marcus lets you keep the interest and doesn't charge you any penalty. So it can be a really good option. So number 3 is the only one that I haven't used for an emergency fund, and I'm not using it all right now, and that's a non-tax deferred mutual fund account. So if you're going to do this, be sure you put it in something stable like bonds. It can't be tax deferred because you want access to it immediately. You also have to make sure it's something that you're not going to get a penalty, or you have to keep at a minimum balance if all of your funds in there. So this isn't what I recommend. This is going to be sort of only for a few people out there. Now, to go back to bonds, if you're going to choose a fund, usually you're going to put it in bonds because they're the safest. Here's the issue. Right now, with interest rates at historical lows, bonds may not perform very well in the future. You see, bonds have an inverse relationship with interest rates. All that means is that as interest rates go up, bonds are actually going to perform worse. They're going to go down. And so right now, they really have nowhere to go but down. That doesn't mean they will for sure. I'm not, trying to make predictions. I think predicting the market is pointless, but it's something for you to keep in mind. Number 4 is an advanced strategy that I've used heavily in the past, and kind of what I revert back to whenever my high yield savings accounts and high yield CDs aren't making me what I want them to. To be fully transparent here, you need a credit card to be able to cover your emergency expenses for 30 days, and it's sort of a headache to set up. But once you get it set up, it's on autopilot and it's not bad. If enough people are interested, I can make a how-to guide on this, so let me know in the comments below if you're interested in that. This is using treasury bills. Treasury bills are basically a US-backed security that you buy at a discount and 4 weeks later sell for full price. So the interest that you're getting from this right now are not as high as they used to be. They were at 2.3 or 2.4 even just a year ago. Now, they're at 2.1. But if our other accounts fall in their interest and they're not making us anything, they're still a great option. Basically how this works is you get on treasurydirect.gov and open an account. When you open an account, you deposit funds and buy bills. You can put in there whenever you're purchasing how many months you want to repeat that purchase. So if you put it in there and buy just one set of bills, as soon as those bills mature, the money goes directly back to your account. If you enter in that you want it to have it repeated for 12 to 24 months, it's going to keep on reinvesting your money. And so what you want to do is do to the maximum every time. A strategy I used was every week I would have bills maturing. And so I would split my emergency fund up across 4 weeks of bills and have those going for a full year. Every year I would get on there and make sure that I renewed the reinvestment. So I had money maturing every single week of the month. I didn't have to look at it though. It was on autopilot. How this works as an emergency fund though is that you have a credit card that can cover your emergency expense. So you swipe the card, take care of that expense, and then go directly to your account after that and cancel that next reinvestment. And it's really easy to do once you're in there and know how to do it. You cancel that for as many investments as you need to get the money out that you need to cover the card within the next 30 days so you don't get charged interest. As soon as that bill matures, it goes directly to your account. You cover the card and you're home free. Now you have a secure fund still making you returns, but you've also got a fund you can use in emergencies. So these are really useful and will probably be what I revert directly back to as soon as we start seeing the other high interest accounts falling down below about 2 or 2.1. And that's because there's another benefit to these in that the returns you're making are tax-free at your state level. For high tax states, this can really make a difference. So at the end of the day, just make sure that you do have an emergency fund. It's important and it can really save you in a tight situation, which it has me recently. And where you put it just needs to meet a few criteria, and to make sure it's meeting that criteria, remember what it's actually for. If you do all that, you'll be okay and you'll be safe. So the question of the day is, do you have an emergency fund and where is it? Do you just have it in cash somewhere? Do you have it in a bank account? I'd like to know, is there a really good option that I missed? Let me know down below. If you're new to the channel, be sure that you subscribe so that you get more of this awesome information and you can share the journey with the rest of us. If you're coming back, let me know how things are going for you. I always like to hear from you guys, and it really just makes my day to know that we're all in this together. So either way, leave me a comment and a like because it really helps the channel to get pushed. I'm brand new, so YouTube has to know that I'm actually doing something that people want to see. With that, thanks for watching till the end, everybody, and I'll talk to you guys next time.